Thanks for joining us as we continue the panel with respect to foreign investment and capital flows and its impacts on the United States. And we are going to have a discussion today that's going to start out a little bit more macro in terms of what we're seeing out there, and then we're going to hopefully try and get a little bit more granular with respect to investment. We're going to try and add some comments with respect to New York and maybe some of the other key markets. Before we get started, we should do some introductions. My name is Brian Ward. I am the Chief Executive Officer of Trimont Real Estate Advisors. We are a global servicing and asset management firm with offices in the United States, UK, and Amsterdam, with about $103 billion of client assets under management. And
has been investing in real estate globally and in the U.S. now for over 40 years, so not a newcomer to the markets. I started about 7 years ago, came out of a New York private equity shop and was asked to be part of a team to help transform ADIA, which has been almost exclusively relying on external managers, to an internally managed real estate platform. So overall, across all asset classes, we're now at about 1,600, almost 1,700 professionals. We have 190 in real estate. We target about 30 countries. We're currently invested, I think, in either 24 or 25, so we invest globally, although the U.S. is our largest single country exposure. We invest across all product types and really kind of focus on relative global value. Probably the highlights. Great.
Hello, I'm Eric Horvat, Managing Director with Fosun Property Holdings. Fosun is a large conglomerate from China, I think the largest private conglomerate from China. We have various businesses in insurance, real estate. We have 64 million square feet of real estate. And we have entertainment and healthcare and other businesses. So Fosun is a global firm. They do business in many, many countries. In the United States, they recently got into the property market in 2013 with the purchase of One Chase Manhattan Plaza, and since then we've done some more. We're about 30 people, 50 people total if you include our private equity teams who have been here longer. So we've been here in the United States for some time. Real estate is more of a newcomer, and we're excited to be part of that.
I'm Dean Shapiro. I'm a Senior Vice President of Investments in Oxford Properties. Oxford is one of the 4 divisions of OMERS, which is a Canadian pension fund. OMERS is about a $100 billion fund, about half of which is invested in public markets, about half of which is in the private markets. 4 major divisions are capital markets, private equity, infrastructure, and real estate. OMERS has been in real estate for a long time. They really took it all in-house back in the 70s with the acquisition of Oxford Properties. So of the total, Oxford Properties today is probably $40 billion in assets under management, about half of which are in Canada and about half of which are split equally between Europe and the United States. In terms of what we've done here, we ventured into the United States probably about 6 years ago, and since then we have invested quite a bit of equity and made a pretty big splash. We're invested selectively in really tier 1 markets, primarily New York, Washington, and Boston.
Great, thank you. So before we dive in, let's set the stage a little bit for where we sit, and then we're going to try and tie that into where we think we're going. So we finished 2015 with about $533 billion of real estate investment, $533 billion of investment into U.S. commercial real estate for 2015. When you compare that to 2007, depending on whose numbers you look at, 2007 was about $550 to $575 billion. So we're coming very, very close to the peak of the market that we saw in 2007 in terms of transaction volume in the U.S. By comparison, 2014 was about $425 billion. When you look at the foreign investment component in the United States, 2014 was about $40 to $42 billion. 2015 was about $91 billion. So obviously a massive, massive increase in terms of foreign capital investment into U.S. real estate. And of course, for those of us in the real estate industry, you could hardly go a day without reading a headline and seeing some sort of news about foreign capital investing in any particular market in the U.S. Of the investment into the United States from foreign capital, Canada remains number one. After that, I think is Singapore, then China, then Norway, and then the UAE. And so it gives you a little bit of a perspective in terms of who's doing it. So that's kind of where we've sat. Now let's talk about where we're going, some of the observations that each of you might have. And again, as I said at the outset, let's start a little bit more macro. You know, the question that everybody loves to ask is, where do we sit in this cycle? And how is both foreign and domestic capital going to play in 2016 and beyond? So Tom, let's start with you and we'll work our way around.
Well, I think it's always an interesting debate. You know, are we driven by fundamentals? Are we driven by monetary policy? Are we driven by capital flows? And I think, of course, the answer is a little bit of each of those. AFIRE just completed a survey, and 84% of international investors indicated that they would either maintain or increase their allocations for real estate in the U.S. for 2016 rather than 2015. So the expectation is that there will not be a slowdown of the foreign capital. So that's one of the elements. And certainly the U.S. has benefited from, I think, being a safe haven and being a very attractive investment market based on transparency and based on a number of other drivers, as well as its relative economic growth. So I think that I'm probably more optimistic than some. Somebody was asking me out front about my view of the markets, and I said quite candidly, it may have changed in the last 10 days. I've been on the road for about 10 days, and everybody was pretty optimistic when I left Abu Dhabi 10 days ago. And the emails I've been getting over the last couple of days, I'm like, what in the heck is going on over there? So I'm anxious to get back, and in fact, I'm sending a note back, and my first comment is don't panic. That's what I'm writing to some of the senior people in the organization. So I'm not quite sure what the anxiety is about. What I hear about the most is just pricing levels, transaction volume levels, and kind of where we are in the cycle. But my expectation is that, I mean, I don't expect to see further cap rate increase or decreases, but I don't think the world is going to fall off a cliff, certainly as far as U.S. real estate. So we remain very active. We just closed a $3.5 billion industrial portfolio within the last 30 days. So we're still active and still looking at 15 or 20 transactions actively. So we're not panicked yet, and I hope my email will be persuasive later this morning.
Eric?
I think you've got a good start to the email. So, I think you said earlier that there's been, a doubling of international, transaction volumes from 2014 to 2015. On the China side, I think that's gone from about 4 billion to, over 10. Mm-hmm. So, and that's from 2014 to 2015. So there's been a big run-up of Chinese investors, I think for all the reasons that was just mentioned about, safety and security, transparency in the marketplace, ability to find, product that you think will have long-term value. So I also maintain a bullish thing on what we've done to date, especially. There has been a massive, run-up on real estate if you're specifically talking, about New York, and I know we'll get to the micro stuff. So I think it's really a market-to-market comparison you have to make and where you're looking to find that value. If I was talking in very, sort of baseball American terms, I'd say we're like in, bottom of the seventh or something. I don't think that, this is going to go on forever. And I do think there's lots of opportunity still to find, and you just have to be cautious.
Dean?
Yeah, I mean, we're a pension fund. We need to pay pensions and we need to invest money. We will absolutely continue to invest. We're always going to have vicissitudes in the market. Markets are going to dip. We're always going to hit turbulence, but we're a long-term player. We're not an opportunity fund, as are many of the investors in this market. So we fundamentally believe in real estate, and we fundamentally believe in real estate in key global markets, New York particularly.
Right. So look, I mean, in my position, I get a chance to really spend time with clients from all over the world, and I get a chance to go visit them and really get a clear sense for what they're thinking. And it sort of echoes what you guys are saying. I mean, there's no secret here. There's still tons of liquidity. That liquidity has to get invested, and real estate remains a favorite asset class for that capital. And And the United States remains a favorite market for all of the reasons that we've talked about in terms of transparency, but also just the formation of some pretty sound fundamentals that I think still have a little bit of room to run, and hopefully they will ultimately prove themselves out. And the world sees that. And so the U.S. is going to become, or is going to remain, a favorite market. And the question will be whether there are some disruptors that come along here and shake things up. But at least for the first half of 2016, I mean, from what I'm hearing, we see really very little risk in terms of that disruption type of thing happening. And furthermore, very little concern about interest rates and Fed monetary policy and the like. So that's kind of what I'm hearing. One of the things that Jeff Blau mentioned that I thought was interesting in terms of China, I also have seen some similar type of commentary, though, which is that will there be a little bit of slowdown in terms of liquidity flow from China here this next year, given some of the broader economic challenges maybe that they have going on. And so we'll see how that plays out. I don't see it really having a material bearing on our market, nor do I really see it having a material bearing on the big heavy hitters like Fosun. I think they're going to just do their thing. And so we'll see how it plays out. So that being said, let's dive now into maybe a little bit more particular discussions about which markets you are investing in, which ones you like, which ones you don't like, and why. And so, Dean, let's start with you, and we'll work our way back this way.
Again, our footprint is extremely limited, and it's not because there aren't other markets that we like. It's that fundamentally, I'll make a generalization about Canadians. I would say Canadians in general are conservative, and certainly the strategy at Oxford is we're not a macro player. We're an active investor, not a passive investor. So we're not going to play in 16 markets, including tertiary markets, because we think that from a relative return basis it makes sense. We're going to choose to spend time in very few markets, generally put boots on the ground, understand the market, develop infrastructure in those markets, really get to know it, and then invest prudently. And that's generally what we've done. And again, we do it with selective markets. I mentioned what the markets are in the U.S. In Europe, it's the logical markets. It's London and Paris. And then obviously it's markets in Canada. So those are the markets we like. And we like them because we believe fundamentally in global markets, that what has emerged over the last 20 years as we've seen globalization in the world has been a few global markets, and we feel that they're naturally resilient for a lot of the reasons that Jeff Blau was talking about, which is it's just incredibly attractive to the type of workforce that people want to be able to attract to their businesses.
Sure. Has the strengthening U.S. dollar vis-a-vis the Canadian dollar impacted at all your guys' strategy?
Yeah, it makes us look really good.
Okay.
It makes the U.S.
for your
look really
for your
good.
current investments, yes, but how does it impact your future strategy?
It doesn't.
Okay. Okay.
I would say from my perspective, there's sort of two layers to that. One is the more global perspective of where we've invested, and to sort of mitigate some of the risks you're mentioning, we have acquired platforms. So, we've went to Japan, and we bought a group called Idera, which had an existing platform, all seasoned veterans. We did the same in the UK with a group called Resolution, and we've made other investments in Australia and in Milan and some other markets as well. Speaking more locally about what we like in this market is, I think 93% of all Chinese investment has basically been in, these big markets like, Chicago, LA, San Francisco, Houston, New York. You've covered like 90% of what has typically been attracting the Chinese money. I think going forward, you'll still see some attraction there. You may see some other markets, Boston and other areas where we would look at. I don't know if we'll go tertiary as well. So I think, in general, we're still very, bullish, but those are the areas we've done that. And to manage our risk, we've put, expertise on the ground. And I think even locally, it's interesting about Fosun's strategy. You're talking about you've become more internal with, managing your own stuff. We have some things where there's more of a GP-LP relationship, but we also have developed a local team in the New York marketplace to do the same thing. So, that's something else we've done.
Okay. Tom?
boy, I had a lot of different thoughts during those comments. I mean, I think it starts with different organizations approach their investment strategies and then how they target in different ways. And Oxford, I think of as really developing expertise in a select group of markets and really going in and having operational expertise and and being deep. And that's I think a very effective strategy for the organizations that possess the operating expertise. You know, our model is a little bit different. It's one of the larger, and we've scaled it. It's probably one of the few investment organizations that's investing in 25 countries around the world that does it under one roof. So, you know, you typically would have offices in Europe and Asia and North America, that type of thing. And so there are real trade-offs, pros and cons to doing that collectively. So we're able to come together quite a bit and spend time face to face. And there's a lot of collaboration. And for you know, young people, one of my sales pitches is you come to work for us and you'll get to see transactions all over the world, not over a video conference or a memo on your computer, but you'll actually, you know, see the partners come in and you'll see the issues debated. So that's kind of the good news. The bad news is it's a hub and spoke and it requires a lot more travel. I mean, one thing that we learned and that we evolved over time is that we have principal investment experience in, I think, all the countries we invest in. There may be an exception or two to that. So by that I mean that for our investments in India, they're all managed by Indian investment professionals. In Korea is the same, and Japanese is the same, and China is the same, and you know, the guys that cover France are different than the guys that cover Germany or Spain or the UK and so on. So they're people with real market expertise that came with deep relationships from those markets, as those of us from the US did. But then we're sitting collectively in, you know, under one roof and trying to make kind of relative value calls with each other and making decisions about the relative risk return attractiveness of doing something in Spain versus Brazil versus India versus in, you know, a secondary market in the US, that type of thing. So there are different, you know, strategies in terms of, you know, how to get there. And I think it has to do with the size and scale of an organization because it requires certain levels of economy. I think our travel budget's, you know, $20 million a year or something. So you've got to have enough scale that you can amortize costs like that. I see new entrants in markets, and a lot of times what they do is they try to develop Rolodexes, if you will. So they'll buy people that have great sets of relationships but don't have real operational expertise, and that's often for new entrants into markets. You know, they'll take people out of the agency positions or brokerage positions, and if you're looking to make a move, you know, that's a very good way to do it oftentimes with a new entrant into the market. But what that profile lacks are people that have actually repositioned and operated buildings and have that deep level of operating expertise that a group like Oxford, for example, would bring to the table. So I think there are different, you know, different ways to get there. I wondered a little bit, but our countries of, excuse me, of size are, I think I've got this right, the US, France, Australia, China, and the UK. I think those are our top 5 countries of the 25 that we're invested in.
Okay. Is the price of oil impacting your strategy at all? Or are you hearing of others talking about oil prices impacting strategy at all?
I would think that it would have to show up at some point. I don't think it really has yet, unless this is part of the noise in the last week. You know, Adia was built when oil was $15 or $20 a barrel, so it's not like the, you know, Alaska Permanent Fund where it was an organization that was built on, you know, very high price levels. It certainly will affect, I think, the amount of incremental new capital that comes in, but when you have a sufficiently large base, and you know, we put out an extraordinary amount of money last year in terms of new investment in real estate. I think it was just under $10 billion of equity, and our portfolio actually shrunk a little bit. So it's an active enough portfolio that you have to pedal pretty hard just to kind of stay in place, given the, you know, given the scale. So we're not really seeing any impact of oil pricing. I'm keeping an eye on the Saudis and some of the other organizations to see if it's affecting them, but I don't think it's really affecting us in the UAE.
Okay. I mean, look, it's no secret we're in a mature part of the market cycle, right? And I get asked all the time, are we in a bubble, or where do we sit, what inning, that kind of jazz. And I don't really have an answer in terms of innings, but for sure we are in a mature part of the cycle, and for sure it's, at some point it's going to change. It's not entirely clear to me exactly when that's going to be. In terms of my interactions with our clients around the world, I mean, all of them are basically saying the same thing, which is we're still investing. We are investors for all parts of the cycle, but we may be adjusting our strategy a little bit right now in terms of how we're looking at things, in terms of leverage or investment horizon and the like. And so people are very conscious about what's going on out there in terms of what they're doing. So let's actually shift and actually talk a little bit about this foreign capital trend a little bit, and then I want to get a little bit more granular. Because another one of the questions I get asked all the time is this foreign capital, this flow of foreign capital, is this a long-term trend, or is this just going to be a flash in the pan like past cycles have been? And so I'd like to get your thoughts on that, and whether or not this is something we're going to see here forever, or is this going to be one of the situations where we've seen in past cycles where capital just left the market the moment things got a little bit dicey. So Eric, let's start with you.
I mean, I think from my perspective, I don't think that, you had mentioned Fosun sort of has a little bit of a bigger strategy, and I think for us that it's not going to be the end of the road because there's some bumps in the market. I think that the fundamentals of the United States and the market they have there, and the diversification from other markets, it's a good tool, and it will stay in the bag, if you will. I bet my career on that. We're going to be growing our business, and we're going to be finding opportunities. And I think there's increased sort of this globalization has caused us to have opportunities where we're finding things from others who have invested here, and I think that we feel like we're going to be having a competitive advantage as we go forward, whether it's materials that we source from other markets, from China, or what we do. But we think that long term we can make it work, and we'll go through those ebbs and flows and stick around.
Okay. I mean, Dean and Tom, I think I know what you're going to say, but go ahead anyway.
Yeah, we're not changing.
Yeah.
I mean, if you think about the type of capital, I mean, when you're talking about foreign pension funds, if you're talking about sovereigns, these are fundamentally long-term investors. I think it's different when there were Japanese corporates and things like that really had P&Ls to manage. I think that the type of most of the incremental capital is for either store of value or long-term investment. So that doesn't mean that you're not going to see rebalancing in the portfolio. I mean, I've noticed, and Jeff referred to it, I think Darcy referred to it, that there's been a little less Chinese activity. I mean, that's directional. That is, at the end of 2015, was there less Chinese activity than there was at the beginning of 2015? I think there was, but the flip side of that was that it was just the opposite story the 2 years preceding that. It was that all the incremental capital, that all the crazy numbers that people were paying for full floor condos in New York that they weren't going to occupy was all Chinese money type of thing. So that will kind of ebb and flow a little bit. I think the foreign investment, I think the capital markets are much more mature, much further integrated, and I think foreign capital is here permanently.
Yeah, I would agree. I think we're officially in a full-time global market. That's right. So let's bring it down to home, to a little more granular here to New York City in terms of what we see for 2016 and impacts on both foreign and domestic capital too, for that matter. What are people going to be doing here? Dean, let's start with you.
Not to be too redundant to our partner, Jeff, personally, I'm a New Yorker by birth, so I'm a little bit biased, but I do believe what Jeff believes, which is New York is a preeminent global market. It's a huge attractor of talent. It is a market and a city that has always evolved since I can remember. It continues to evolve. And I think foreign capital respects that, and they see that this as a very solid market. They've seen huge appreciation here. And like London, it's if you're looking for long-term stability for investments, this is a great place to be.
Okay. I spend a lot of time in London, and people love London, but it's just hard to find product, you know? So you're going further out to Birmingham and Leeds and Manchester, and it's just like,
hugely expensive.
you know,
Yeah.
and it's just like, just the weight of demand versus supply is becoming a major issue. And so they all agree with you that, you know, New York is the place to be. Eric?
Yeah, I think I would echo that, and you know, we're very bullish on New York, and we have, you know, a couple investments we've made. We already feel very, very good about them, and you know, we like some other markets too. And I don't know, you know, what the others would say about this, but you know, when it comes to, you know, finding risk-adjusted returns that make sense and making sure that you are being able to deploy a reasonable amount of capital at a time, you know, you're sort of drawn to these more major markets. So I mean, we like Chicago. There's other markets we think can make fundamental sense for us.
So surprise us. Give us a market that you're looking at that we wouldn't think that the Chinese capital would otherwise be looking at right now.
I don't think I have that for you at the moment.
Okay.
So yeah, I think we're staying to the course of, like, you know, the areas that we think are gateway cities are the ones that we've been more attracted to.
Okay.
And there's an kind of an implication of your question here that it sounds like most of this conversation is about office product, and there are, you know, at least 4 or 5 major food groups. Mm-hmm. And I think, you know, as we think about geographies, those vary a lot. I mean, we limit our office investment typically to major primary markets that are very deep. I have conversations that are disappointing with people, you know, making inquiry all the time, and they'll say, well, look, you know, I'm calling from this great city, and we have a population of 900,000, and we've got all these great things going on, and won't you consider an office investment in our city? And generally the answer has been no, because, you know, even if we cut a city size off at $1 million or $2 million, when we look around the globe, we're not looking around just the U.S. I mean, you think about China alone, how many cities that puts into our, you know, our scope. So we're not out buying office buildings in cities with populations of 500,000. But on the other hand, a dominant regional mall in a market like that, or a multifamily project, looking at logistics and fulfillment and distribution space, those are obviously things that are going to need to be much more diversified and certainly not limited to the major deep markets.
Okay. To give you all perspective in terms of volume by asset class, and I'm trying to remember, so of the roughly 500 billion in U.S. transaction volume, I believe about 150 was office, about 150 was multifamily, about 60 billion, I think, was industrial, and then there was hospitality and other in there as well. But clearly, multifamily and office have dominated. We have heard a consistent theme around the interest in industrial product. It's just been hard for people to find. And obviously, we've seen major compression in yield over the last 18 months in the industrial space as a result of that demand. So anyway, okay. Good, thanks. Let's go to kind of the taxation and regulatory discussion a little bit, because one of the things that we talk about when foreign capital is investing abroad, the moment you cross a border, you have all sorts of challenges, whether it be logistics in terms of setting up offices. And Eric, I think it'd be really helpful for people to hear what approach Fosun has taken vis-a-vis what other people have done. I mean, obviously, Audia is really running a hub and spoke type of situation, but it would be great to hear your guys' thoughts on sort of the world of taxation, regulation, and just practicalities of running a global business and how you deploy capital and repatriate it and so forth. Mm-hmm. So why don't we kind of start with that general theme? Tom, let's start with you, and we'll work our way around.
You surprised me by starting with me first, so I'm just going to gather my thoughts here a minute. But yeah, I think from our standpoint, we are looking at kind of a net world. We're looking at global relative value. We're looking at a return profile measured by some form or some various metrics of risk, looking at it at an after-fee, after-tax basis. So when you look at the regulatory environment and you look at the tax scheme in various jurisdictions, they obviously weigh in. I mean, something as simple as for those of you that manage funds, if we have a fund investor let's say that generates 18 to 20% gross returns, if they're doing that in Europe and we happen to be investing with them, we'll probably net something close to a 15. And if we do that with them in the US, we'll net something close to a 12. So that's this, the same manager and the same return profile. So I remember when we had a new head of tax at ADIA, a guy stood up, he was a Brit, it was one of the top firms, he said, I don't think we should invest anything in the US. And I said, wow, why would you say that? And he said, well, because it's the most oppressive tax and regulatory system in the world for real estate investment. And that may be a little bit of a stretch, but there's some, potentially some truth to that. And his view was, throw the returns, throw the market transparency, everything out the window. It's just so complicated relative to other jurisdictions. So it does factor in, but the great thing is that it's such a fantastic country and the opportunities are so great that it succeeds in spite of all that. But it's certainly a factor, and I think we have 560 different entities in the U.S. That we use for investing in real estate. So it presents a very complicated world for us, much more difficult than any other market in the country or in the world.
Eric?
Yeah, so I think from Fosun's standpoint, we're sort of hub and spoke as well. It's, I work out of Shanghai, and the thing is, I think you'll see this more and more. If you're a global firm, and Fosun has a lot of, conglomerate businesses, right? And one of them is insurance. So we've sort of been following a Berkshire Hathaway model, using those insurance companies as a way to, grow our platform in general, right? So if we do a deal in the United States, it's not just a China-US thing. It could be a China-Portugal thing or a China-UK thing, and figuring that out is something that's part of the challenge. So I think when you're talking about regulation, we're thinking about, first of all, that flow of funds of how we're going to work through that. And then I think, secondly, if you're looking here, there's been recent changes to FIRPTA and how that's going to, it's a little bit more loose, but, the rate has gone up from, 10 to 15%. There's something called, CFIUS, right, which is a committee of foreign investment in the United States, which is a whole new factor, which could start impacting transactions. I don't know if it will's never been a factor for us, but, there's sort of a changing world a little bit with some real regulation. As you said, it is a regulated environment, and it's also because of the global nature of that has impacts that are beyond real estate potentially. So you have to think about that when you're making those moves, and it'll be interesting to see how that plays out over the next couple of years.
Okay. Before I get to you, Dean, are you guys repatriating your capital, or do you leave it in the country where you have it invested? So when you have a capital event, does that capital come back to Abu Dhabi, or does it stay?
It's a hard question because, the answer to any question that's asked is it depends, right? And so...
You took my answer.
We have a lot of different entities, and there are entities that are more tax efficient than others. So, for example, if what's being realized is in an efficient entity, that may then be reinvested as equity. Secondly, if it's not, it may be loaned to another entity. I think that the general question is, are you a net investor? Are you not divesting in a country? And if you're net investing, somehow, whether you're netting dollars, trading dollars, or not, you're putting more in than you're taking out. So I think for us, the decision about whether an individual transaction is repatriated has a lot more to do with regulatory and tax efficiencies than anything else. We're net investors in the U.S.
Got it. Okay, thanks. Dean, I cut you off. Go.
Well, no, I'll just answer that as well. We basically borrow money from our parent. So when there's excess cash, we sweep it back to the parent, so we're not paying for it. But as I said before, the U.S. has an allocation, and this is very high-level planning about where we want to be as an organization in terms of diversification. So that money is available to us on the basis that we can have it approved on a particular transaction.
Okay. Do either of you see any changes in sort of the regulatory framework? Obviously, there's been talk about FIRPTA and the like, but is there any changes in the winds that you see that could either be a benefit or a detriment?
Well, I'll be the first to applaud FIRPTA. We're one of the few firms that it actually applies to. So it's made our lives easier. It was unexpected, but it's a great
I've not
gift.
heard somebody saying FERPTA makes their life easier.
It
That's a
does.
first.
It makes her life easier. For a pension fund, it makes her life easier.
Okay. Okay.
Beyond that, nothing in particular.
Okay. How about you, Eric?
You're really not, nothing that I can think of that's going to change that. The only thing, we don't utilize EB5, but, I understand there's changes that could be abreast on that, increasing, from 500 to 800,000 on the, on a per person basis and things like that. So it'll be interesting to see how that plays out from a regulatory standpoint. But from our standpoint, I don't know.
Any discussions in the wind at all?
Yes, thank you.
What's that?
EB5.
Yes.
And we're obviously highly reliant on
impacts you more than
EB5 for Hudson Yards. Don't know
So
how
explain EB5 really briefly for folks in the audience, just so they all know.
Well, EB5 is a Visa for Jobs program, which actually can actually produce significant amounts of capital if you're able to raise it. It's not uncomplicated. And the program has actually been around not only in the U.S., but in other countries for decades. But it's only recently come into the spotlight because it's been utilized it's been very effective, and it's been utilized for some very high-profile projects, Hudson Yards, certainly being one of them. Some would say that it's being used for a purpose that was not the original intent, and that may or may not be the case. The reality is, for many years, it was underutilized, but today it is, we've actually exceeded the allotment of visas because it's become so popular. But as a result of its success, it's gotten a lot of scrutiny, and it is under extreme scrutiny by some of the members of Congress who are seeking to change it and make it, in their mind, more fair and a more even playing field, and a program that is more directed to rural areas than to urban areas.
Okay.
So there are ways of evening the playing field from their standpoint, and that could make it more difficult to raise money for significant urban projects.
Okay. Eric, I was going to ask you, have you heard of any rumors in the winds about the Chinese regulatory environment and whether they might be changing their thoughts on outbound capital for 2016?
No.
Okay. Okay. It's also important to bear in mind for a lot of the Chinese capital investing globally, a lot of those institutions trade, for example, on the Hong Kong exchange. They don't trade on the Shanghai exchange. They're less impacted maybe by what's going on in Shanghai. So when we talk about the Chinese business in general, it's more complicated than that.
I mean, I do think that, the treaty, the tax treaty that we have between the U.S. and China was like done in 1986 or 7. So, who knows?
Okay. Okay. Sorry, sorry, did you want to?
Can I stir your panel up here a little bit?
Absolutely.
Is Jeff Blau still in the room? He'll hate me if he's still here. But I think this EB5 thing is really controversial, and so I think it's up there with abortion and global warming. I wouldn't fall into any. If you're not really familiar with it, I would not really fall into any quick assumptions on it. You can think about it and debate it. Clearly, there are real estate projects and developers that have benefited greatly from it, and that may or may not be a good thing. Just sharing my perspective. So I live in a country that allows work visas. You're there for a finite period of time, and at some point in time you have to leave. You can't retire there, and I couldn't become a citizen over time. And I work in a country with 71, 2 or 3 nationalities right now. So there are people from 73 different parts of the world. And for everyone that works in Abu Dhabi, except for a U.S. citizen or resident, it's tax-free to them. So they're really happy not to pay property taxes or sales taxes or income taxes. And so everything is a tax-free world if you're from, Switzerland or France or Japan or anywhere else, no matter how high the tax rate may be.
Sounds like heaven.
So unless you U.S. It's great for Canadians if you're looking to do something different. But the conversation around the lunch table is that people are saying, okay, great, I'm making, whatever I'm making today. I can't stay here forever. Where am I going to go? So, one guy was talking to me about what he was making, which was a, unbelievable amount of money. And he was subject to a 75% tax rate in Paris, and it was 0 tax rate in Abu Dhabi. So he was liking the 0 tax rate. But he was saying, okay, so when I'm through here, where am I going to go? So the conversation is a lot about where somebody might try to establish citizenship or residency. And there's 71 or 72 nationalities that sit around and at least kind of hypothecate on where they might reside, where they might retire, where they might live. And the joke on America is it's the cheapest ticket in the world. The EB-5 is that you can give a lawyer that runs an EB-5 fund a $500,000 investment, and he charges a big load and a big fee, and it gets scraped, and some of that money may end up somewhere, some of it may not. And you basically can get, if you're one of the, if you make it inside the lottery, and these guys control some of the tickets, you can get full residency. So you can send your kids to Berkeley at in-state tuition, and you can get all kinds of benefits. You get every benefit that American citizen would get. And there's a lot of countries that have something similar. That ticket's about 5 million euros in Austria, and there are numbers. Canada's not too much higher than the US. But there are places that are easy to relocate to and easy to get almost all rights. And we sell that. We sell that in America for a modest investment with the idea that it's going to put capital in places where it wouldn't otherwise go. So I guess no one would invest in Hudson Yards unless we had an EB-5 program. And so anyway, needless to say, I'm not a big EB-5 program fan because I look at it from the lens of people that are looking around the world. And it rates up there with, it's about the cost of something like Nevis or St. Kitts or something. It's a really, really, really cheap entry ticket. And I happen to care more about this country than that, and I think it's worth more than that. I think we're giving it away.
Okay. On that, on that note, really quickly, just 30 seconds from each of you, what do you see in 2016 as the big risk? Dean.
A rescission of the EB-5 program.
You don't want a panel that's all going to agree with everybody. It gets boring.
Right. I'm neutral on this one. So I think, from my end, I think it's just, the macro plays of what happens in the world and, financial things, So to me, it's just like, I think things will continue on as we've all said. It's just what are those major pops that will delay things. So I think right now things are okay. There is obviously some volatility due to oil and others, but I feel generally bullish, and we're still excited about the market.
Tom?
I would say slow growth. We've been on a diet since the global financial crisis of quantitative easing and a little bit like a drug. It's been enjoyable and it's inflated asset values. We're beginning to see that dialed off. Our European brethren and some other countries around the world have joined our strategy and joined the U.S. strategy and brought it later. So that will end. I don't think there'll be indefinite quantitative easing across the world forever. And so as that slows down and we go back to more normalized cost of capital, I think it's going to put a lot more pressure on true growth rates. And if the U.S. is 2% versus 3%, that makes a big difference. And if China is 4 versus 7 or 8, that makes a big difference. So I think we're going to be in a slow growth mode for the next couple of years.
Okay. Yeah, I just would echo that. I think for me, barring some crazy black swan event, I think it's just the unknown impacts of removing liquidity from the market and how that ultimately affects asset values. I think that's really the great unknown. So with that, we are at time, but I think we wanted to open it up for questions. And how much time do we have for questions?
Yeah, till 10:15.
Okay. So questions? Yes, sir.
Hi, my name is Pierre Mohan. I'm with X, and I appreciate the explanation about the EC5, EB5. I was hoping you could also explain FERPTA, how that works, and what has changed with it recently. It's impacting our business.
I am by no means the world's greatest expert on that. I could just tell you that the stringent requirements for how we partner in the U.S. and liquidity issues that creates in terms of having to sell REIT shares versus entities has now been significantly relaxed.
So FERPTA stands for the Foreign Investment and Real Property Tax Act. It basically affects foreign investors in U.S. real estate with a 10% withholding upon sale. And if there's lawyers that can further elaborate, but it's basically an additional withholding tax for foreign investment in U.S. real estate. There are ways to structure around it. There are ways to structure the transaction as debt instead of equity that ultimately can either bypass or minimize FIRPTA, but there are, like I said, there's tons of expertise out there. It has acted as a concern for foreign capital because it's just an added tax, right, with respect to their investment. And I would echo Tom's comment earlier, which is the biggest concern that I was hearing from foreign capital investing in the United States was our taxation and regulatory environment. Up until about 18 months ago, people would cite that often as a concern. You know, the US tax regime is complicated. I'd rather go to the UK. It's more clear. It's more predictable. The last 18 months, people have like, taxation be damned. I don't care. I'm just looking for returns, and I'm looking for a place where I can park my capital and be safe. And so it hasn't played as big of an issue today as it might have been in the past.
And I think the headlines on FIRPTA, the December 18th bill,
That's right.
is that it increased an exemption to FIRPTA for foreign pension plans. So those aren't sovereign, so that would theoretically have no effect on ADIA. But if you're structured as a pension plan, so you're the CalPERS equivalent of another country, then you have you would have an exemption. And then also, as Dean referred to, there's a little bit of clarity in terms of kind of the structural dismantling, the liquidation, and how you dispose of and repatriate assets. And there's a little bit of clarity that's been added to that. The other thing that was significant, I think, is that you can own now up to 10% of shares in public real estate companies versus 5%, and have tax-free benefits from that. So I think the general, and for the tax experts in the room, forgive me, but I'll butcher this a little bit, but the general idea is that the U.S. is open to foreign investment as long as it's passive. If you want to give us your capital, you reduce our cost of capital to run activities, and in doing so, we'll give you we'll give you either a portfolio interest exemption if it's structured as debt, or you could have dividends that are potentially tax-free. That's so long as you don't have control, you don't have a lot of influence, and you have a very low percentage. Well, that low percentage was historically defined as 5%. So a foreign company could own 4 to 5% of a REIT, for example, and those distributions could be tax-free. That's been moved to 10%, and that's pretty significant. And I say that because in our organization, there are other sister sovereigns like the Abu Dhabi Investment Council, and so we're always concerned that we'll be consolidated. And so a 5% limit for us is not 5%. We'll take it at like 3.5% or 4% because we'll give ourselves some cushion. So if we're capping ourselves at, let's say, 4%, and the number just went to 10%, then we could probably go to 9%. So we go from 4 to 9. So it allows us potentially to put a lot more money in the public real estate markets with on a tax advantage basis.
Just one quick comment from me on that, which I'm not the expert on this either, but as it's explained to me, we haven't done anything since December 18th in the new act, but it basically, the essence is, it makes it a little simpler to avoid some of the issues, but the tax actually increased from 10 to 15%, the withholding rate.
Right.
So that's what's happened.
Okay. Next question? Yes.
Yes, Kirk Wetzel from Bisnow. We really haven't talked that much. What do you see the hottest areas here in New York City for the foreign investment for the coming year? Specific trends.
Gentlemen?
I would tell you, I mean, from our standpoint, we're value investors, and so at the end of the day, we're in New York City itself, we're believers, but like everything, it's all about the deal. It's all about the specifics. It's all about the partnership. It's all about, entitlements and risk mitigation. So I don't think you can be so specific to say, oh, we love Tribeca lofts today or, something else. It's just it's a more broad-based thing, and it's really believing in the area as opposed to a specific submarket.
Yeah, I could just say a couple of consistent themes for us in terms of our investing here has been, we like boutique office buildings because we believe that that's a resilient part of the market, and we like high street retail. We think that that's very strong as a long-term play.
Sorry, yes.
I have a question about infrastructure investment as a first cousin, as an asset class where we need lots of it if you could comment upon any investment programs you have or what you're currently thinking about in this category.
I mean, we have an infrastructure group, but none of which would apply to sort of New York area infrastructure. It's mostly, we own toll roads and pipelines and rail lines and things of that nature. But I think it's safe to say that the U.S., relative to other parts of the world, is behind the 8 ball in terms of privatization of infrastructure. And given the needs that we know about, you would hope that in the future we evolve more towards private ownership. We would hope that would be an opportunity for us going forward.
Okay. I can't contribute. Sorry. Go ahead.
I mean, it sounds like a topic for another conference because it's such a big, it's a big question. But I mean, we have an infrastructure group that's much younger. It's about 10 years older, that we're active around the world, but we're active in the U.S. But it feels like a drop in the bucket at the end of the day. I think the problems are so immersed. I mean, Secretary Pritzker, I mean, one of her big issues is that, we need an infrastructure bank. I mean, we need to be doing this on real scale and have a true governmental kind of alignment and policy behind it. We are, as Dean said, way behind, and it's always scary to hear these statistics about, the percentage of bridges that have, reached their useful life and road systems and all that kind of stuff. It goes on and on and on. So it's a big problem, and it's certainly an area that I think is not going to get solved solely by the government. It's going to be a public-private partnership, but there's a lot to do, and that's going to be a 10 to 20-year process.
Okay, last question. Right here.
Thank you very much. Just to give you a quick question, and this is less guided towards the funds side of things, so more your JVs and if you're going direct. What is your kind of average hold period? What kind of things are you looking for in terms of returns from US investments? Probably more for Dean and Eric.
We're long-term holders. We're not flippers. It depends on the investment. Obviously, for development deals, we like to have them be double-digit if we can have them. We're not a big core player because even for a pension fund, to buy assets at a 4 cap is difficult for us.
Yeah, I think I would echo exactly what you're saying. So, we do have one project that is a high-end condominium that we think will do well, which is in Midtown. But beyond that, I think we're long-term core players. We're value investors that, like long-term real estate.
Yeah, I don't think there's an easy answer to that. I mean, I think about it like putting together your portfolio is like putting together a sports franchise, and every asset is a individual unit of talent, and you may have expectations that something's going to be persistent and have 20 or 25 years, and something may happen in that market, and you feel like that's not the case. So it could be anywhere from a relatively short-term hold to, we have assets in New York that we bought in the mid-'70s, so it runs the whole gambit.
I mean, at the risk of stating the obvious, return expectations have come in a little bit, right? I mean, as more and more capital has chased transactions and we've seen more competitiveness in the marketplace, I mean, people generally have compressed their return expectations. Yeah. I mean, it's really such a question of fact, though, as to asset and market and everything else that it just depends. But we are, again, stating the obvious, we're in a mature part of the cycle.
And as Brian said, I think one of the manifestations of that is that you see organizations that are morphing to either secondary products or secondary markets. Pure real estate investors that are investing in biomed or self-storage or some product type that's cold storage, things like that, that I'm saying, wow, you've never been investing in this, and they're, in chasing yield, there's been some, some migration, some diffusion in terms of what people have invested in. Mm-hmm.
Okay, well, thank you to all of you. Thank you to the ULI, New York, and to my panelists. Have a great day, everybody.